So once you enroll in Medicare, either Part A or B, you can no longer contribute to a health savings account. So that's definitely first thing you have to be aware of. And you also have to notify your employer that you've now enrolled in Medicare if you're working past age 65 so that they can stop contributing to your health savings account also, because neither you nor your employer can contribute once you're enrolled in Medicare.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 91. And if you are considering enrolling in Medicare or Social Security this year, and you contribute to a health savings account, otherwise known as an HSA, for part of the year, you need to be aware of the tax penalties that could apply for over-contributing. And in this episode, I'm going to cover how to avoid triggering those penalties and what you can do if you've over-contributed to your HSA. And if you're a listener of this show, you're aware that I'm a big fan of health savings accounts. They are an unknown way that you can be saving for retirement. And often, maybe even if you're saving in one, you're not aware of how to make the most of this account. And you might be making some mistakes with the management of this account and giving up potential tax savings opportunities. So if you're not aware of that, I would definitely suggest that you go back, listen to episode number 1, how to make the most of your health savings account, and episode number 44, top providers for HSA accounts. You can find those episodes by going to retirewithryan.com or searching for them on your favorite podcast app. One of the penalties that applies if you over-contribute to your health savings account is a 6% over-contribution penalty. And this could trigger if you're enrolled in Medicare and you inadvertently contribute to your health savings account. And this penalty would apply per year on the contributions and earnings that you've put in. So this is definitely a penalty that you want to avoid. And normally people do try to avoid this. They're just not aware of how this can be triggered. So once you enroll in Medicare, either Part A or B, you can no longer contribute to a health savings account. So that's definitely first thing you have to be aware of. And you also have to notify your employer that you've now enrolled in Medicare if you're working past age 65 so that they can stop contributing to your health savings account also, because neither you nor your employer can contribute once you're enrolled in Medicare. Many times people aren't aware of this. They keep contributing, and this is often caught by your tax advisor when preparing your return, but usually it's after the year is over and it's too late to withdraw the contributions and avoid the penalty. It could also create additional taxes and penalties that you owe on your salary, because everything that you put into your health savings account is a pre-tax deduction. So obviously, if you were no longer able to contribute to this account, then you'd have to file a corrected tax return because you took a deduction that you weren't eligible for. And you can help avoid this by knowing what health insurance you have if you're going to work past 65. If you work for a large company, a company that has 20 or more employees, you can generally remain on that health insurance and work past 65. This also goes for your spouse. Let's say that you're working past 65, your spouse is covered under your health plan through work, then they can delay enrolling in Medicare past 65. There's no reason really not to do that. However, if your plan covers less than 20 employees, if you work for a small company, then you'll need to enroll in Medicare. And sometimes people think this is to avoid the Medicare Part B penalty, which there is, but in this situation, this wouldn't apply. That would be if you just had no health insurance. You would avoid the penalty, but it would really help avoid any gap in coverage, because for plans that cover less than 20 people, once you're supposed to have been enrolled, your health insurance pays secondary to Medicare, so Medicare would be your primary coverage. And if you're part of a plan that does cover more than 20 employees and you're going to work past 65, you'll definitely need to monitor those HSA contributions, because once you enroll in Medicare, as I mentioned before, you have to stop contributing to your health savings account. And one of the mistakes that could come with this is that a lot of times the wisdom was in the past that you should enroll in Medicare Part A as soon as you turn 65. Medicare has two standard parts, Part A and Part B. Part A is free as long as you've worked at least 10 years or your spouse has worked 10 years. And Part A covers part of the cost of a hospital stay. So if your plan is to keep contributing to your health savings account, you're going to keep working past 65, you wouldn't want to enroll in Medicare Part A because any enrollment in Medicare stops your ability to contribute to your health savings account and also receive any contribution that your employer might be contributing. So you definitely want to wait until after you retire to enroll in Medicare. And you have 8 months after you retire to enroll in Medicare without a penalty, if you're going to work past 65 and delay your enrollment in Medicare. Another mistake that can come with this is that if you're working past 65 and you're collecting Social Security before enrolling in Medicare, maybe that's part of your plan. You're going to keep working and you're going to start collecting Social Security while you're working. You do have to be aware of some of the income limits regarding that. And if you want to learn more about that, I would suggest you go and listen to episode number 74, 7 Things to Know About Working and Collecting Social Security Benefits. But once you enroll in Social Security, it's mandatory that you are now enrolled in Medicare Part A. So you might not be aware, you might be thinking, okay, I'm going to keep working, stay on my employer health plan that covers 20 or more employees, but then I also want to start collecting Social Security. Well, unfortunately, just the act of collecting Social Security triggers Medicare. So if you are trying to stay on your health plan and keep contributing to your health savings account, then you definitely wouldn't want to do that. And this was affirmed by a ruling in U.S. District Court in 2001. 3 federal employees sued the U.S. government because they didn't want to enroll in Medicare Part A, and they wanted to stay on their government health plan, the Federal Employees Health Benefit Program, but they also wanted to collect their Social Security benefits. And it was a 1965 law that created both Social Security and Medicare that provided the answer, and Judge Rosemary Collier stated that requiring a mechanism for plaintiffs and others in their situation to disenroll would be contrary to congressional intent, which was to provide mandatory benefits under Medicare Part A for those receiving Social Security retirement benefits, meaning that the ruling states you cannot disenroll from Medicare Part A without losing your Social Security benefits. So you could delay your Social Security benefits, but as soon as you enroll in them, now you're going to be put on to Medicare Part A. And that could be a savings. For some people, if you have expensive health insurance, either through your employer or maybe you're self-employed, there could be a savings for you by enrolling in Medicare. But for some people, it might actually be more of an expense because you have to pay the Medicare Part B premium, which is $170 a month. That's the minimum premium. There could be a upcharge from there, and that's per person. So that is something you have to weigh. And as part of this, once you start collecting Social Security, Medicare Part A is retroactive to age 65 or 6 months if you're older than 65 and a half. So let's just imagine that you're going to retire on July 1st of this year, and you've already contributed to your health savings account for this year, and maybe your employer already contributed. Then you enroll in Social Security, so Medicare Part A is retroactive back to January 1. That means that the money you contributed for the first half of the year was not allowed. So you would need to remove those contributions, or else you're going to have to pay the 6% penalty on your contributions for as long as that money sits in there. So that's where definitely doing some planning in advance of when you're going to collect Social Security is important to make sure you don't run afoul on that. And HSA contributions are often made on an annual basis, so that in my prior example, imagine that you enroll mid-year, you're not eligible for a full year of HSA contributions. Let's just say that you don't enroll in Social Security right away, but you just enroll in Medicare halfway through the year, then you'd only be allowed a prorated annual contribution. So you'd calculate that by dividing whatever your annual limit was, divided by 12, and that's the monthly amount that you can contribute to your health savings account, so that if you're only eligible, let's say, for 5 months of the year, then you multiply 5 times the monthly amount, and that would determine what the amount is that you can contribute. So definitely be aware of that, because very few people are retiring on January 1, that if you have contributed to your health savings account for the year that you retire, make sure that you're not also putting in more than the prorated amount that you would be eligible for. And after you're enrolled in Medicare, the funds in your HSA can continue to grow. They don't have to come out. You can leave them invested. You can take withdrawals at any time. And if you use them for qualified medical expenses for you, your spouse, or dependents, there will be no tax. So that's one of the main reasons why I'm such a big fan of these accounts. Even using them to save for retirement, because you get a deduction on the contribution when it goes in. The money can grow tax deferred, and if you use it for health-related costs, it comes out tax-free. And many providers now allow you to invest the money. If not, then you should definitely listen to the episode Top HSA Providers, episode 44, so that you can get an idea of what some alternatives might be if your provider isn't allowing you to invest the option or isn't giving you good investment options to choose from. And also, once you reach 65, you can take distributions for non-qualified expenses, and they will just be taxable to you. There will be no 20% penalty, which would apply if you took any distributions before 65. For non-qualified expenses, you can take qualified distributions at any point, so that even if you do build up a large health savings account balance and you don't believe you're going to be able to use all those funds for qualified medical expenses, that's okay. You can take the money out and pay tax just like you would have if the money was in a retirement account. So let's just say you're listening to this episode and you've now realized that you made excess contributions to your health savings account. How do you fix it? Well, one way is that you can just withdraw the excess contributions before the tax filing deadline, but make sure to have your HSA trustee, wherever your HSA account is held, code those as an excess contribution rather than as a distribution, because this is money that you inadvertently contributed, so therefore it's not taxable to you when you distribute it. And if you don't reverse the excess contribution by the tax filing deadline, which would be April 15th, many years, then you'll be responsible for paying ordinary income tax plus a 6% penalty on the excess amount of that money every year it remains in the account. Next, you might be wondering, can I stop Medicare and start my HSA again? Let's just say you enrolled in Medicare, you realized I didn't mean to do that, I want to be able to contribute to my health savings account. Well, the short answer is no. Social Security and Medicare go hand in hand, as I mentioned, and you'd need to stop. Let's just say you're receiving Social Security checks. You'd need to stop collecting those checks. You need to pay everything back that you received. Or if you were on Medicare and you had started making claims, then you'd need to pay back all your claims. So it's pretty cumbersome to do that. So rather than doing that, definitely make sure that when you do enroll in Medicare or do collect in Social Security, that you're okay stopping contributing to your health savings account. So I hope this episode was helpful on how Medicare enrollment can impact your HSA contributions. If you have a listener question that you'd like to have considered for a future episode, you can send me that question by going to retirewithryan.com, filling out the contact form with your information and your question, and I'll consider that for a future episode. Thanks for listening. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.